All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro Podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. John, what is our topic today?
Today's topic is, again, we try to keep it somewhat topical, but we don't want it to be too short-lived, but it's central bank independence. And as of right now, we have renewed pressure on the Federal Reserve, so very timely. But rather than just saying the central bank is doing the wrong thing, which everyone has an opinion, and by all means, you should have your opinion. But let's talk a little bit about why independence exists, who doesn't have independence, and what it renders. See some of the circumstances in the backdrop, and go through it. And I think that that's really a useful conversation, so you're a little bit more up to snuff on where we're at with this kind of conversation, and it might change your view on whether the central bank should be independent or not independent. So with that being said, Matt, what is central bank independence by your definition?
Essentially, central bank independence just means that a central bank, which generally speaking sets interest rates and monetary policy for a country, that they're able to do those things without interference. And there's an obvious tension here with the long-term perspective, essentially the perpetual life of a central bank, versus some of the political pressure that we can see for politicians who are looking out just until the next election cycle, which is often a short period of time. To put a fine point on it, oftentimes politicians want a strong economy, so they're more likely to be reelected and can sit in their cushy jobs for longer. However, well, central banks can sort of support the economy in the short run, that in the long run can risk higher inflation. Most major central banks have a target of low inflation, whether that's 2% or 3% or not defined. But generally speaking, economies thrive in the long term when you have low and stable price pressures or inflation. And also many central banks target things like financial stability or a healthy labor market with low unemployment. So that natural tension between the timeframes, I think, is often the sticking point for central bank independence. And at the end of the day, the proof is in the pudding. The central banks that are objectively more independent than ones that are subservient to the government tend to get better economic results. Things like lower inflations, healthier labor markets, more confidence in future growth. So I think it might be retracing obvious steps for some of our listeners, but I think it's important to outline where this came from and why it is so important ultimately. And for our viewers, you're pulling up a chart here that was from a study done by the European Central Bank that essentially found that the more independent central banks are, the more credible their policy is. And of course, if you lose credibility, that's when you can lose investment in your country. You can experience high inflation, low growth, a weaker labor market. So there's a clear correlation between credibility and independence. And in many ways, credibility for me is just an analogy for good economic outcomes. So it's kind of a esoteric topic, but it's certainly one that's highly relevant right now, and one that, in all likelihood, I anticipate will be relevant for decades to come. Did I miss anything talking that through, John? Anything you would add?
No, I think very important emphasis. You say the politicians are looking for a strong economy. And generally speaking, I think that central banks, whether they are independent or not, are directed to the same thing, a strong economy. But there are certain things you can do that will benefit the economy in the short run at the expense of the long run. A good example of this is how the notion of the quarterly earnings report puts executives in a position where they are always trying to meet the objectives, the immediate objective of the fiscal quarter or the fiscal year, at the expense of a long-term blue chip growth and benefit of the company. And that's a good argument to have. Maybe that's a future topic, but um, you do need to look beyond the political cycle, whether it be 2 years, 4 years, more, and look at the long term stability and balance some of those factors. So I agree with that totally. I just want to reemphasize that. But perhaps it's important to talk about the why for independence, which you touched upon a little bit. But I think looking at some of the factors of what they're trying to achieve, because it's not easy to get. You can totally focus on inflation, and you're ultimately going to pursue inflation with your tools, whatever they might be. It's not just interest rates changes; it's also there's quantitative easing, quantitative tightening, which has been more popular in the developed world, and there are other things we can do actually in a shorter duration, the availability of funds and money supply. Um, or it can be a pure focus on unemployment, or if you want, unemployment's usually a proxy for the economy's health. So maybe you're just focusing on growth, and financial stability is its own thing. These are very important. They're all very important for the healthy functioning of an economy, but to get all of them is not at all easy. So that's why you often have certain objectives, and we know the Fed's objectives. We call it the dual mandate, is a focus on inflation and unemployment, and they've also suggested that there is a financial stability. Skeptics would also say that they're just trying to keep the capital markets bolstered, which is probably not as far fetched as some might think, because the healthy performance of a capital market is usually indicative of a healthy economy. Usually, I'm going to say usually, really emphasize that usually, but it ends up being these two core dual mandate factors. But it's the whole purpose of the central bank's independence is to keep targeting these things that represent, in essence, a healthy economy and healthy growth and stability. And if you're, I think, directed by government officials or government entities, that focus can change and change on a dime according to, let's say, election cycle, but also the focus of whatever that group might change for external political purposes. And all of a sudden, your focus on the economy is secondary, which you could argue, is it reasonable to make a shift away from the economy as a central bank, and financial stability? I don't know, Matt. Do you see any reason why you would, as a central bank, move away from that objective?
Generally speaking, no. I mean, I want to double click on your point there, in that there's always this balance. There's this tension where we'll come back around to the Fed, but right now, clearly, the executive branch believes that the Federal Reserve is conducting monetary policy in a way that's overly afraid of inflation, that interest rates should be lower. So you might get into a situation where reasonable minds may disagree. Maybe focusing as much on financial stability in a certain moment is less relevant. But broadly speaking, I think these goals are hallmarks of a healthy economy. So, generally speaking, the ultimate objectives are the same. It's just a matter of which one you're emphasizing at any given time.
Hmm. So let's look at a range. There's a range of totally independent to totally government controlled. I think we can flip that and start with the totally controlled to see what it renders. I think I know you wanted to talk about Turkey, so we'll look at the USDTRY and we'll bump it up to a weekly chart there. Apologies for these lines if you're watching the video. These are all the times that they either kept rates unchanged, cut rates, which are red, and hiked rates if they're in green. As you can see, the Turkish central bank is quite active. Um, you wouldn't notice it if you didn't have these lines, because the USD TRY exchange rate is a pretty consistent rise and has been from 2022. Perhaps that's one of the factors to take away from this. What would you say about Turkey and the Turkish central bank and its objectives?
Yeah, so not getting too far into the politics, but president, I believe is his title, maybe prime minister now, Erdogan, um, took a very active role in the last half decade or so in setting monetary policy and advising, you could say generously, the central bank on what to do. This is kind of the quintessential warning that other countries, more developed countries, countries with more stable central banks should be aware of, because when the market perceived that the central bank had lost most of its independence, that's where we saw that massive depreciation in the lira. We saw inflation surge, and then subsequently, as the central bank perhaps tries to get back its credibility, we've now seen interest rates surge. Just to put some numbers to that here, interest rates went from about 8% a few years ago to as high as 45%. I think it's down closer to 30% now when you're talking about the CBRT's interest rate. Inflation got well over 60%. So these are very negative outcomes that essentially make it very difficult for your populace to thrive. And then another measure of credibility is just how sort of stable is it at the top. When I checked in the preparation for this podcast, we'd seen 5 governors for the Central Bank of Turkey in the last 5 years. So essentially, regardless of what they were seeking to accomplish, they weren't in place long enough for them to achieve their objectives. And this constant turnover leads to a lack of continuity. And again, not a coherent plan for the economy, for monetary policy. So I think this is the page one warning of what can happen when the market perceives that a central bank loses its independence, and it's resulted in the evaporation of untold wealth for the country. So it's absolutely a warning sign. I don't think we're anywhere near there in any of the major developed countries, but it's certainly something to be aware of. Would you add anything there on Turkey, John?
No, and I've for the chart I added the difference between the U.S. and the Turkish interest rate. And typically, the U.S. interest rate, as it would compare to the Turkish interest rate, getting to the carry trade for the FX traders out there, you would typically see Turkey as a higher yielding place to park your capital, and usually you would see the yield differential would align to the exchange rate, very much the opposite, as we've
Mm-hmm.
seen, especially in 23, 24. And the stability risks, obviously, in Turkey are a consideration there. But you start getting away from that deep credibility. I'll use a term you used that would make it a safe place for a carry trade, and certainly a very limiting factor that you have there. But I think very similar is the a much larger economy, a much larger central bank, and arguably the second largest central economy in the world to compare to the U.S. is the Chinese yuan. So here you have a very strong influence as well. The Chinese central bank is very much directed by the government. It is a government entity. Here you actually have some alignment, and that's probably through sheer liquidity. But there is also this, we'll call it flippancy. The Chinese government is very mindful of the economy, very mindful of its trade position. It has to be, because it is still very much dependent upon the global economy to consume its goods as a key source of GDP. And that's one of the reasons why it rose from below the 20th largest economy in the world to the second largest economy in the world in very short order. So they will align, but it does deviate. And you can see in the USD CNH, there is a essentially control. Um, and the Chinese government wants the exchange rate to be under control because they are a large exporter. If their goods are too expensive because the Chinese yuan becomes too expensive, you first have to buy the currency to buy the goods. Then it really hurts their economic output. So that exchange rate control is not necessarily under the guise of the PBOC, but those tools have to work in coordination for this to happen. So it ends up being a very, I'll say, well managed, not necessarily well as being a good thing, but it is certainly managed in a very effectively between monetary policy and the exchange rate. But both of those things are managed, and that can have significant impact. And we see a lot of the argument, or the arguments made by the United States last year, that and this is not just of the Trump administration thing. There are accusations that the Chinese government is artificially manipulating its exchange rate and doing trade conditions, other trade conditions, untoward of a economy of its scale, to maintain artificial advantage. And this kind of policy action would argue that case for sure. But would you add anything else to the Chinese central bank? Maybe a word to also to the Hong Kong. Actually, let me talk a little bit about the USD which is actually an exchange rate. Until a few years ago, Hong Kong was a special administrative area for China, so disputed its independence. Obviously, China took it back ahead of its supposed freedom period. And even before then, China was pushing a lot of capital through Hong Kong, which was interesting because Hong Kong is also it's a managed exchange rate. It is very much between a range of 785 and 775. And yet, all this capital flow in and out through Hong Kong with the destination of China or China to where the capital was ultimately going to go, which I always found very interesting between the USDCNH and the USDHKD about how they deviated. But now utilizing this kind of this tool, which isn't aligned to the actual tools that they are applying in their mainland approach, I always thought was fascinating. But would you add anything to the control approach of China slash Hong Kong?
It's a it's an interesting situation because it comes back to what we talked about at the beginning, at least in my view. One of the main reasons that central bank independence is so important is because of the lack of agreement in timeframes between politicians, for example, that want a certain economic outcome before the next election, and the long-lived monetary policy and stability of the economy. I think China provides an interesting exception that proves the rule in a way, and
Mm,
that much
mm,
of China's ruling political class is not likely to be usurped in any sort of election anytime soon. So therefore, they can afford to take this longer term perspective. And to your point, we haven't seen any sort of economic meltdown or anything in China because, at least for now, that there's this sort of long term perspective and the willingness, perhaps, to take near term pain for those long term objectives. So I think it's an interesting spot in that if that ever changes, perhaps we could see a smaller version of the Turkey situation. But for now, there is sort of some alignment there. And this is an example where a central bank that is, frankly, not that independent whatsoever is still able to achieve decent economic outcomes because, again, it doesn't face that pressure to make myopic decisions. So that's the only thought I had
mm.
that came to mind on that specific
Good point.
example.
Very good point. Very good point. All right, let's go to a central bank that's somewhere in the middle, skewed more aggressively towards independence than, let's say, the Turkish or the Chinese central banks. But this is one that we agreed to was a good example, and that was the Bank of Japan. The Bank of Japan is one of the largest central banks in the world. The Japanese yen is one of the most heavily used currencies in the world. So it can't really abide by too extreme a deviation from the normal Western style of central bank independence. And yet, it is certainly collaborating, if you were to use a favorable term, with the government. And a great example of that is if you look at a dollar yen chart, which I have already tooled up for us here. There are periods throughout history where the Ministry of Finance has directed the Bank of Japan to go into the exchange rate market and either buy or sell Japanese yen according to where it's at. Now, this is often done with the knowledge of G7, but there's also times where it's just uh, assumed or suggested or hinted at because of extreme volatility or extreme levels. And obviously, the G7 is not as happy with the Bank of Japan when it does intervene on behalf of this exchange rate. But normally, they do these types of things, I think, also because they've had the difficulty of dealing with 3 decades of deflation, again, a byproduct of a very important component of economic activity. If you don't pursue it properly, then it becomes a serious issue. And I think that they've been dealing with that issue for a long time. Although recently they've started to have inflation pick up and stay elevated, so they've started hiking rates, very much out of step with the most the rest of the world. But I think that they're pursuing that rate hikes outside of the consideration of the level of the exchange rate, which you continue to see the dollar yen is elevated, historically speaking, even though the Bank of Japan is hiking and the Fed has been cutting. And we also have the political pressure with the new prime minister as of last year. Anything you would add to this kind of equation and where they stand? Perhaps you feel they have skewed one way or the other in the past year or so?
I have two prominent thoughts that come to mind, and one is just reiterating something that you said, in that this is a central bank that they would argue only during times of stress, but has been known to coordinate with the government. Well, now we see some tension between the new government, which tends to be more stimulative in its approach in an attempt to fight off deflation, versus the Bank of Japan, which seems to be inclined to raise interest rates, which all else equal would decrease economic activity in an attempt to make sure inflation doesn't get too high. The other thought that comes to mind is that we're just seeing maybe the start. And I don't. This trade was literally called the Widowmaker 30 years ago because everyone was waiting for it to happen. But we are just starting to see a situation where interest rates on some of Japan's longer term debt is rising. It's at multi-decade highs at the same time that the yen is weakening. Now, I by no means am drawing a direct parallel here, but this is what we saw in Turkey to a much greater extent, where interest rates are rising, but that's not attracting capital to the country. Perhaps the interest rate rise is being driven more by fiscal concerns and large sovereign debt loads that is not compelling for outside investment, because those debt
Mhm.
loads are so high that there's questions about whether it will be paid back. So this is one that I'm going to be watching very closely this year. There's I want to be very cautious about drawing those parallels there, but certainly the relationship between the yen and longer term interest rates appears to be breaking from some of the norms that we see in the developed world, and that'll be an important storyline to watch moving forward, especially as it ties into this tension between the Bank of Japan and the Japanese government. I'm trying to talk very delicately here and not inspire any panic, but is that something you've noticed, John, or any insights on your side?
Yeah, I think you summarized it very well. I'd also add that over 3 decades of near zero interest rates and deflation, there's been a really core expectation that the Japanese yen would end up being a funding currency for the carry trade, which is a one-way trade for a very long time. Obviously, it goes back and forth according to risk on, risk off. If it's risk off, you unwind the carry trade and you go back into the original currency. But it was really aligned. This starts to break a little bit that expectation, but interest rates for Japan are still very low. And you pointed out very well the fiscal concerns that are there. But this is where that independence question is really going to be at the forefront of how is the Japanese yen treated, because there's also questions about economic potential going forward, and monetary policy plays an important role in the overall health and potential of an economy and its financial system. All right, so let's finish off talking about what we consider to be one of the more independent central banks, kind of the litmus test for independence of central bank, but it's under pressure recently, and that is the Federal Reserve. The Federal Reserve has long been considered to be one of the top central banks. It is the top central bank, the largest economy, and largest reserves on record. Obviously, represents also the U.S. dollar, which is the largest or most heavily used currency. So it is truly a big player in the schema. And as we saw in the beginning, there is a dual mandate that they follow that is target inflation, typically of 2%, and low natural unemployment. That doesn't mean zero. So if you're not an economics major, didn't have economics courses in college, you won't get to zero. You shouldn't at an economy of this scale. But it should be fairly low, and U.S. interest rates is very low even now, even though politicians make cases one way or the other. Historically speaking, the unemployment rate for the United States is about 4.4%. And if you look back over history, that is fairly low. And this is where the debate gets in to the Fed about maybe we shouldn't have to be worrying so much about the unemployment rate because that is still very low, historically speaking. But if we look at the US CPI, that is still elevated above our target. And now the argument becomes that balance. and they're, a lot of armchair quarterbacks. That's fine. We should all have our views on monetary policy. I tell you what, I wouldn't want the Fed job. That would
Mhm.
not be a great job. Everyone's going to
Especially
have
now.
their opinion. Oh yeah, absolutely not. And speaking of now, the White House, President Trump is not a fan of the Federal Reserve and Jerome Powell in particular. He believes the U.S. interest rate is way too high. They have actually cut that interest rate significantly down from a 5.5. Currently sits just below 4. He believes it should be 1%, and that I guess the people that articulate a little bit better for him why is that there's a risk to the economy, although he still believes the economy is doing great, and that inflation is just a unnecessary thing to target. Although I think most of the Fed believes that it's still a major concern. So he disputes, I think, the balance of importance and perhaps the forecast, which I think a lot of us would debate. We have our own views on the forecast, but this is the pressure that we're currently seeing. And as of I think this past weekend, we heard that the Fed Chairman Jerome Powell, who will retire in May, is under investigation by the DOJ for, I believe, the costs of overhauling the central bank's main buildings in Washington D.C. So this pressure is there, and it's it can be billed as not being it's a specific person for specific reasons, but we have seen the White House and the executive branch really pressuring the Fed's independence. So it'll probably be an ongoing issue, and beyond just criticism. But what's your take on the situation there, Matt? Do you think it has real traction of undermining its independence? And what do you think would happen if we cut the benchmark rate to 1% in the United States?
Inflation. Easy answer. Yeah. It appears that, at least in our current economic backdrop, a single digit, well, a 1% interest rate would lead to inflation. Seems to be pretty straightforward and hopefully not too debatable. I would start by putting this pressure on the Fed, which seems unprecedented, into a bit of a historical context. This is not the first Federal Reserve chairman who's faced pressure from a president. In fact, back in 1965, so 60 years ago now, President LBJ apparently, according to some reports, physically pushed the head of the Federal Reserve, William McChesney Martin, up against a wall because he was so frustrated that at the time Martin was raising interest rates to fight inflation. This is in the midst of the Vietnam War.
Mm.
And nonetheless, perhaps an optimistic story here, Martin didn't rescind that interest rate hike or anything, and indeed continued to raise interest rates slightly. That reinforced for the market the perception of the independence of the Federal Reserve, and has taken us to where we are now, where the U.S. economy is, broadly speaking, benefited over the last 60 years. So I think it. If we put that into historical context, there is increasing pressure, certainly over the last couple of years, on the Federal Reserve from the executive branch, and then it does sort of come to a head very soon, perhaps in the next couple of weeks here, with the appointment of a new Federal Reserve chairman. The other thing I'd note is you mentioned that Powell is quote unquote retiring. It's actually just the end of his chairmanship. He does have the option to stay on as a Federal Reserve board member, I think, for a couple of years.
True.
So I wonder if some of this recent pressure we've seen might push him more toward that, even though just looking at how he looks now versus a couple of years ago, it looks like he could definitely escape to a beach and relax after all this stress. But I think maybe in the interest of preserving the perception of independence, whether recent developments might push him more towards staying on the board and hopefully ensuring a smoother handover. So we'll see. Frankly, the market's not too perturbed by it. We do see, as I'm speaking to you guys now, it's the 12th of January. It's a Monday. We see gold and silver at record highs. That to me makes sense if there is some concern, but we don't see any perception in the market that the Fed will immediately acquiesce and start cutting interest rates. Indeed, it's only about a 25% chance ahead of a CPI report that we have tomorrow that the Fed will cut interest rates even by March in the first quarter of this year. So while interest rates still look likely to edge lower across this year, it doesn't seem like we're seeing that loss of credibility that we talked so much about at the beginning. But any sort of marginal shift there certainly can have impacts, and especially when you're talking about economies as large as China's, like we did earlier here in the US, even Japan. If those central banks are seen as losing just a little bit of independence, well, maybe that means down the road inflation could be a little bit higher. The currencies could be a little bit lower valued in favor of some countries that are seen as better stewards of capital. So there are real economic effects, but so far it doesn't appear that markets are at least reacting too strongly to these developments. So it's a storyline I'm going to be watching closely and we'll continue to cover here. But for now, it's just something that we wanted to provide this historical context, this backdrop for why central bank importance is seen as so important for traders. So that's kind of what I'm watching now, and will likely be a key storyline at least through the end of Powell's chairmanship in May, and perhaps beyond that as well.
Sure, absolutely. Well, thanks for tuning into the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe for wherever you get your podcasts. I'm John Kicklighter.
And I'm Matt Weller. Join us again next week for more insights into the trends and events shaping the world's financial markets. Thank you.